Hello and welcome. In this lecture video, I'm going to be talking about fundamentals of accounting and four general principles of accounting, four accounting assumptions, forms of business entities, and then look at a few quick check problems as well, okay? So when we talk about fundamentals of accounting, in the first lecture video, we talked a lot about what is accounting. And I wanted to just take a second and continue that conversation. If you've had accounting in high school, and I've had some students who've had accounting in high school, and I often like to ask them, how would you describe accounting? Did you think it was a math class? And they'll say, yeah, maybe it's got some math. And we do some math. We don't do any calculus in this class. We don't do any geometry. We do a little bit of algebra. And then beyond that, we do addition, subtraction, multiplication, division. But the one thing that can be a little bit tricky is some word problems. And so we will do word problems in this class. I just wanted to give you that heads up. But accounting is not really a math class, all right? What accounting is, it's a language. It's a language with some math. That's the way I like to think of it. And so when we think about what is a language, what are some characteristics of a language? Well, first I always like to say, well, there's vocabulary. Right? I took German back when I was at Mary Washington undergraduate, and in high school I took German, and we had to learn a whole lot of vocabulary. What is the German word for apple, for example, for milk? You had to know the vocabulary. And accounting is the same way. There's a lot of vocabulary in accounting, and accounting does form the vocabulary basis for business. So accounting is often called the language of business. So when we think about, again, what are the characteristics of a language? You got vocabulary. So in this course, you're going to learn a lot of vocabulary. You're going to talk about what we mean by cost of goods sold, operating expenses, net income, what's an asset, what's a liability. Those are vocabulary terms that you need to know. Okay? The other thing, if you think about a language, what else does a language have? It also has rules. So in German, for example, if there is a helping verb, the helping verb goes in the middle of the sentence, the action verb goes at the end of the sentence. That's the rule. That's the way German works. There are similar rules in accounting. Okay, so we have rules of accounting on how we record transactions and how we communicate financial information to external and internal users. Okay, so we have rules on how we record transactions. And we talked about in the first lecture video that accounting does deal with recording, identifying, recording, and communicating information. So we have rules that dictate how we record information and also rules that dictate how we communicate that information. Just like syntax in a language. And then the other thing, if you think about a language, so it has vocabulary, it has rules, it also has culture. So when I took German classes, we learned about the German culture. We learned about Oktoberfest, for example. Accounting also has a culture. And you might be thinking, well, that's kind of strange. Well, it does. And one of the aspects of the culture of accounting is the idea of conservatism. I don't mean that Republican, Democrat, although probably a lot of accountants, I would suspect, do vote Republican. Not all of them, but they do tend to be more conservative. Not everybody. It's a general rule. But that's not what I'm talking about. What I'm talking about is being conservative on how you report assets or liabilities. Okay, so if there's any question, right, we're going to take the lower of the amount. So for example, if we have inventory, if we're a merchandising company, which basically means we purchase inventory and then we resell it, what we have to do is we have to value that inventory at either cost, what we bought it for, or the market value. Okay, so which one do we choose? The cost that we bought it for or the current market value? Because we could have, let's say we were selling iPhones, we could have some iPhones that are 5 years old. Those are not worth anymore what we bought it for. Maybe we bought them for $500 to resell for $1,000, but they're not worth $500 anymore. The market value of an iPhone drops as soon as the new model comes out, right? So which one do we value it at? Do we say, well, the value of the iPhones that we could sell is $500, which is the cost, or maybe it's $200, which is the market? Well, the rule in accounting, which follows the idea of conservatism, says we report at either lower of cost or market. So we have to report inventory at either lower of cost or market. That's the idea of conservatism. Okay, that's what I mean by conservatism. So reporting either the lower of the two, which is the more conservative way of reporting. Okay, so recap. Accounting is a language with math. What do we mean by a language? It has vocabulary, it has rules, and it has culture. And we talk a lot about the rules and vocabulary in this course. So when we talk about how do we come up with the rules of accounting, well, we have our generally accepted accounting principles, pronounced GAAP. Okay, so financial accounting is governed by GAAP. GAAP forms the rule basis for financial accounting on how we communicate and record information. And so as we were saying on that first lecture video, we want to have our information be relevant, reliable, and comparable. And GAAP helps us to produce financial information that is relevant, reliable, and comparable. The Securities and Exchange Commission, the SEC, has the legal authority to set GAAP, but it has delegated that to the Financial Accounting Standards Board, the FASB. So the FASB sets GAAP. Okay? There are 4 general principles in accounting which really govern the rules for accounting on how, again, what do I mean by rules? We're talking about those rules of how we record transactions and how we communicate financial information, just like a language. So the first one is we have our revenue recognition principle. And what that's saying is that we recognize revenue when it's earned. Okay? We recognize revenue when it's earned. So let's talk about that. Let's say that we're Mary Washington bookstore and we sell a t-shirt and a coffee mug to a student. Okay? And then that student says, I can't pay you now. I'm going to pay you in 2 months once I get some more money. Okay? So Mary Washington, this probably would not happen. Let's just go with this example. Mary Washington bookstore, if they said okay to that situation, they can still record that as a sale, even though the student can't pay them yet. Okay? So let's think about that not just with Mary Washington Bookstore, but any corporation, any organization. Company A sells customer B some widget. Okay? And then the customer B says to company A, I can't pay you now. I can pay you in 2 months from now. The question is, can company A still record that as a sale, which is a type of revenue? Yes, they can. Even though they haven't been paid yet, they can still record that as revenue, as a sale, even though they haven't been paid. Why can they do that? Because the revenue recognition principle that says we record revenue when it's earned, not necessarily when we get paid. So we record revenue when it's earned. Why did company A earn it? Well, they passed title of that product. They sold that product. Company A sold that product to customer B. And when they sold it, they passed title. We said, it's no longer ours. It's yours. They have passed title. Therefore, they can record that revenue because they have earned that revenue because they passed the title on to customer B. Even though they didn't get paid up front. They haven't gotten paid yet. Okay? They haven't gotten paid yet, but they can still recognize that as revenue. Okay? Another core principle is the cost principle. And so what we're saying over here is that accounting information is based upon the actual cost. So let's say that Mary Washington goes out and purchases a building. Well, they have the purchase cost of $100,000. The tax assessment said, well, that's $120,000. And then the seller, that they were going to buy it from, the seller says, wow, I think it's worth $110,000. What have we recorded at? The $100,000, which they bought it at, or the $120,000, which is the tax assessment, or what the seller thinks it should be worth. Well, which one is the most objective? What you bought it for. There's no arguing with that. It's not subjective at all. A tax assessment is subjective. But what you bought it for, you said, this is how much I pay, and then Mary Washington transfers the money. That is objective. You can't argue with that. So what Mary Washington would do is they would record that transaction, purchasing a building, the cost that they paid for it, not the tax assessment. Those could be the same dollar amounts, but they could be different. Okay? So what are we recorded at? The cost principle. Okay? So let's talk about the idea of the matching principle. So what this is saying, a company has to record its expenses incurred to generate the revenue reported. What does that mean? Well, it basically says that an organization needs to match revenues and expenses in the same accounting period. When we talk about accounting period, we talk more about that in another chapter, but we're typically referring to 1 year. Okay, so we have to record revenues and expenses in the same accounting period. Okay, so for example, Mary Washington goes out and buys a building. Okay, so when they buy that building, they record the cost of that building at cost for the cost principle. That's what recorded at. And what that building is, that's an asset. Okay, and I just use another term there. That building is an asset. Okay, an asset is something that the company owns or possesses that helps to generate or has economic value and helps to generate revenue. Okay, so they have an asset, the building. Now, when does that building show up as an expense? So our income statement, I'm going to start using some more words here, and this may not make complete sense yet, but it will as we go throughout more lecture videos. Okay, but I'm going to go ahead and start using these words now. So it shows up, the purchasing that building shows up as an expense. An expense is a cost of doing business on the income statement when it is depreciated. Okay, so when we buy the building, what we have is we have an asset, and then what we do is we spread the cost of that asset over the periods for which we will use that building, that asset, to help us to generate revenue over its useful life. Okay? That idea of spreading out that cost over that building as an expense over multiple years, the reason that we do that is because of the matching principle. Because we will be using that building, let's say it's a classroom. We're going to move into the College of Business into a new building. We use that building to generate revenue over multiple accounting periods. So therefore, we have to spread the cost of purchasing that building over multiple accounting periods, the same accounting periods that we use that building to generate revenue. Why? The matching principle. Okay? The full disclosure principle says the company is required to report the details behind financial statements that would impact users' decisions. So we have a financial statement that we'll talk about called the statement of cash flows. And this shows exactly what you think it might. It says, well, here's how much cash the organization is bringing in. Here's how much cash the organization is spending. So Mary Washington says, well, this is how much cash we're getting from tuition. This is how much cash we're spending on faculty staff salaries, for example. Okay. The full disclosure principle would say that let's say Mary Washington goes out and purchases a building, but they don't pay any cash for that building. How could they do that? They take out a loan from the bank for the entire amount of the cost of the building. So did Mary Washington pay any cash yet? No. Would they still have to disclose that on the statement of cash flows? Yes. Why? Because of the full disclosure principle. Okay? So I'm going to end this lecture video now. And in the next lecture videos, when I'll talk about those 4 accounting assumptions and then also forms of business entities and do some quick check problems. Okay? Thanks so much.